Hello, hello, hello. Welcome to Al Stock Trades. Let's get to it. CPI data came at 6% year over year, expected 6%, which means that the market is rallying. It was primarily driven by shelter. We're going to go ahead and read the overview here. Came in at 6%. It's the lowest since September of 2021. You're going to wake up today, and that's all you're going to basically hear about. Lowest since September 2021. Long story short, consumer prices rose 0.4% in February as expected. Shelter was the largest contributor to the monthly increase, accounting for over 70%. Excluding food and energy, and core prices rose 0.5% from the previous month. Prices of shelter, recreation, household aims, and airfare rose. Used cars and trucks and medical care decreased, great, and the year-over-year core prices rose 5.5%. Now, if we go here, you're going to see here, inflation 6% over the last year, slowest since September 2021. You can see the futures are all up right now. Interestingly, crude oil is down. We're going to go ahead and take a look at that later today or tomorrow. But I wanted to go ahead, quickly diverge and talk about something that happened with the banking crisis over the weekend. So we went ahead and attached some heavy due diligence regarding, the research in terms of, is this a great time to go in heavy on the financial sector? And based on our research, it was definitely a great time. We said here, the new lows on the 1 and 3 month basis suggest a bounce could be coming, but managing risk is essential. And what we found here doing our analysis, we found that consumer finance and all these banks, there is a significant increase in prices. And guess what, ladies and gentlemen? If we go ahead and take a look at First Republic, it literally went as low, even lower, to $17.53. And if you look at it now, it is literally up $48.49, 55% on the pre-market. Now, if we go ahead and take advantage of this $17.53 and put that there, $17.53, and we calculate this, individuals that took advantage of this research gained a whopping 183% of their money. You know why? Because guess what? People were fearful. If you go ahead and look at the liquidity of First Republic, they were injected with it. There was a multiple bigger bailout. And guess what? Their exposure rate was actually less than Silicon Valley Bank. And this is why it's important to do due diligence. And this is why, taking advantage, many people took advantage of what happened in the past 3 days. Many people. And I'm very excited to, give you this data here and present it to you. And overall right now, what does this mean to this gentleman over here? What does it mean for the Fed? So inflation essentially came at 6%. Now the Federal Reserve has enough gas power to say we have conquered or kind of conquered inflation, and perhaps maybe the market is correct regarding the expectation of a maybe 25% basis point rate hike, or even then, some folks are saying that no basis point rate hike and basically start cutting. So this is in line with the latter, and I must say it is definitely going to be crazy. So we're going to go ahead and continue following this, because think of this. Whoever tells you that this bank bailout is not a bailout, this is incorrect. The Federal Reserve is injecting liquidity into the market, okay? And this changes the world of our economy. Now that we are basically backing up banks to infinity, what does that even say to our FDIC insurance? So, in terms of bank regulation, I don't know how that's going to be. That the United States government just changed the rules there. But overall, it's basically almost safe to say we are slowly conquering inflation. And once inflation goes below 6%, ladies and gentlemen, if you look at the historical inflation rate in relation to the stocks, inflation rates lower than 6%, it equates to actually an above market return. Above 6%, it's choppy. We're going to go ahead. I'm going to sign off. If you like our research, there'll be a link down below for our products, stock terminals, and beyond. I'll see you on the next one.